Here is a fact that should concern every new business owner. The majority of small businesses that fail do not fail because they had a bad product. They do not fail because they had no customers. Many of them fail while actually making sales. They fail because the money coming in and the money going out were never properly managed, and by the time the owner realized something was wrong, it was already too late to fix it. You can have a full order book and an empty bank account. You can be making sales every week and still not be able to pay your suppliers or your rent. This happens more often than most people realize. And it happens because the business owner confused being busy with being profitable. Today we fix that. Welcome back to the Business Foundation series. This is episode 9, and we are continuing phase 3 on money and the legal side of business. In episode 8, we talked about how much money you actually need to start. Today we go deeper into what you do with the money once it starts coming in. If this series has been helping you, please subscribe and share this episode with a fellow entrepreneur. Understanding money management is genuinely one of the things that separates businesses that survive from those that do not. By the end of today, you are going to understand why poor money management kills more businesses than poor products or poor marketing, exactly how to separate your personal and business finances, and why this is non-negotiable, a simple system for tracking your income and expenses that takes minutes per week, and what profit actually means versus what most people think it means. Let us get into it. Let us start with the core problem. Most new business owners treat their business bank account like a personal wallet. Money comes in from a sale, and they spend it. On supplies, on personal expenses, on things the business needs, on things the business does not need. Without tracking, without categorizing, without any clear picture of where the money is actually going. And for a while this seems fine. The money is there, things are getting paid, life feels normal. But underneath the surface, 3 problems are building that the business owner cannot see. Problem 1. They do not know their real profit. Revenue is the total amount of money that comes into a business. Profit is what remains after all expenses have been paid. These are 2 completely different numbers, and confusing them is one of the most dangerous mistakes in business. A business owner who makes $10,000 in sales in a month and spends $9,800 in costs has made $200 in profit. But if they are not tracking their expenses, they might feel like they had a great month with $10,000 coming in and spend accordingly. Then the bills arrive and there is nothing left. Real example, a woman who ran a small tailoring business was consistently booked and earning what felt like good money. She never separated her personal and business finances. She paid for fabric, tools, transport, and personal groceries all from the same account. At the end of each month, she had almost nothing left despite being busy all the time. When she finally sat down and tracked every expense for 1 month, she discovered that her actual profit after all costs was less than 15% of her revenue, and a large portion of that was being spent on personal items she had not categorized as personal. Once she separated the finances and started tracking properly, she was able to identify where the money was leaking, cut unnecessary costs, adjust her pricing slightly, and within 3 months had doubled her take-home profit without acquiring a single new client. Problem 2. They cannot make good decisions because they have no data. In business, your financial records are not just a history of what happened, they are your decision-making tool for what should happen next. Should you hire someone? Should you buy a piece of equipment? Should you move to a larger space? Should you expand your product line? All of those decisions require knowing your real numbers. Without accurate financial records, every decision is a guess dressed up as a choice. Problem 3. They are unprepared for taxes, audits, and growth. In almost every country, businesses are required to pay taxes on their profits and to maintain some form of financial records. If you have been running your finances casually and someone official asks for records, you are in serious trouble. Beyond compliance, any future investor, lender, or serious partner will want to see your financial history. A business that cannot produce clear, organized financial records is immediately treated with suspicion, regardless of how well it is actually performing. This is the most important practical step in this entire episode, and it is also the simplest one. Open a separate bank account for your business. That is it. That is the single most impactful financial decision a new business owner can make. When personal and business money are mixed, you cannot accurately calculate your profit because you cannot reliably separate business expenses from personal ones. You lose track of what the business actually owes and what it owns. You create accounting and tax problems that are painful and expensive to untangle later. And you are constantly tempted to dip into business funds for personal needs, which slowly bleeds the business dry. Here are the 4 steps to clean financial separation. Step 1. Open a dedicated bank account for your business. Even before you formally register your business, designate a separate account exclusively for business income and expenses. Step 2. Pay yourself a salary. Set a fixed amount you transfer from the business account to your personal account on a regular schedule. This is what you live on. It keeps business money and personal money permanently separated. Step 3. Use the business account exclusively for business. Every business expense comes from the business account. Every business payment goes into the business account. Step 4. Record every transaction. Every movement of money in and out of the business account gets noted, quickly and simply, but consistently. Real contrast. Business owner A mixes everything together, cannot tell profit from revenue. Tax season is a nightmare. Regularly feels like the business underperforms, but cannot identify why. Business owner B uses a separate account, pays themselves a set salary, tracks every transaction. At the end of each month, the numbers speak clearly. When decisions need to be made, the data is already there. Same business type. Completely different clarity and control. You do not need accounting software to start. You need a spreadsheet with 5 columns. Column 1, date. Column 2, description. A brief note about the transaction. Column 3, category. Income, supplies, marketing, transport, software, salary. Column 4, money in. Amount received if this was income. Column 5, money out. Amount spent if this was an expense. Once a week, for 10 to 15 minutes, go through your business bank account and enter every transaction into the spreadsheet. 1 row per transaction. At the end of each month, total your money in and money out. The difference is your result for the month. Here is what a week of entries looks like for a small service business. Monday, client A paid invoice, money in, $500. Tuesday, design software subscription, money out, $30. Wednesday, transport to client meeting, money out, $12. Thursday, client B paid deposit, money in, $200. Friday, personal salary transfer, money out, $300. 5 entries, 5 minutes, complete picture of the week. At the end of the month, total everything up. That gives you your baseline numbers for calculating profit, which takes us to the final section. 3 numbers. Every business owner must know all 3 and must never confuse them. Number 1, revenue. The total money that comes in from sales. If you sold $5,000 worth of products or services this month, your revenue is $5,000. Revenue tells you how much activity the business is generating. Number 2, gross profit. With revenue minus the direct costs of delivering your product or service. If revenue is $5,000 and your direct costs were $2,000, gross profit is $3,000. Gross profit tells you how efficiently your core activity converts to money. Number 3, net profit. Gross profit minus all other operating expenses. Rent, software, phone, marketing, your salary. This is the true bottom line. If gross profit is $3,000 and indirect monthly costs are $2,200, net profit is $800. This is the real number. This is what the business actually made. Net profit margin is net profit divided by revenue. 800 divided by 5,000 is 16%. That is a real workable number. You can ask, how do I get that to 20%? Reduce costs? Raise prices? Add more clients? Now the most common mistake, looking at your bank balance and calling it profit. Your bank balance is not your profit. It is a snapshot. It does not show outstanding invoices not yet paid. It does not show bills due, but not yet deducted. Profit comes from your records, not your balance. Full example, a freelance web developer, first full month. Revenue, $6,000 from 3 clients. Direct costs, freelance help hired for 1 project, $800. Software licenses for client work, $150. Total direct costs, $950. Gross profit, $6,000 minus $950 equals $5,050. Indirect costs, laptop amortized monthly, $40. Phone, $30. Internet, $25. Co-working space, $60. Marketing, $50. Personal salary, $2,000. Total indirect, $2,205. Net profit, $5,050 minus $2,205 equals $2,845. $6,000 received, $2,845 actual profit. Knowing that number is what makes every next decision possible. One final concept, profit versus cash flow. A business can be technically profitable and still run out of cash. This happens when clients owe you money they have not yet paid while your bills are due immediately. The solution: invoice quickly, follow up on overdue payments, and collect deposits before beginning work. Managing cash flow is just as important as managing profit, and both require tracking consistently. That is a wrap on episode 9. You cannot manage what you do not measure, and you cannot grow what you cannot see. The businesses that survive are not always the ones with the best products. They are the ones where the owner knows their numbers. Here is your homework before episode 10. This week, set up your 5-column tracking spreadsheet. Open a business bank account if you have not already. Enter the last month of transactions if you have them. Calculate your revenue, gross profit, and net profit. That number tells you exactly where you are and what needs to change. If you found this useful, please subscribe and leave a comment. And share this with an entrepreneur who you think is confusing revenue with profit right now. It might save their business. In episode 10, we complete phase 3 by talking about the legal side of starting a business, how to register, the different business structures, licenses and permits, and what protects you personally if the business ever faces problems. See you there. Take care of yourself and take care of that business.